In today's video, we'll delve into the intriguing world of stock splits and highlight 3 prominent companies that have recently announced or completed stock splits. Stick around until the end, where we'll reveal a special bonus tip on how to maximize your gains from stock splits. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. Stock splits are fascinating events in the stock market that can make shares more accessible to a broader range of investors, particularly those who don't have access to fractional share buying in their accounts. They also generate excitement among investors and often draw significant attention to the companies involved. Today, we'll compare Nvidia, Chipotle, and Broadcom, analyzing their financial metrics, market positions, and potential as investments following their stock splits. First up, let's talk about Nvidia, ticker NVDA. Nvidia has already adjusted its trading to reflect the stock split, with shares now priced at $128. This semiconductor giant has surged ahead in the AI revolution, with a recent increase in revenue driven by its cutting-edge graphics processing units, GPUs. Over the past few years, Nvidia has consistently innovated, introducing new generations of technology that keep it at the forefront of the industry. Its latest product, the Blackwell GPU, is already shipping to customers, and the company has even more advanced technology, codenamed Rubin, slated for release next year. On the financial front, Nvidia leads the pack with a substantial revenue of $79.7 billion in the most recent trailing 12-month period. This positions it well ahead of Broadcom, which generated $42.62 billion, and Chipotle, which brought in $10.2 billion. Nvidia's rapid growth can be attributed to the skyrocketing demand for its GPUs, essential components in the booming AI sector. As Nvidia ramps up production to meet this demand, it's clear that the company is poised to maintain its lead in revenue among these 3 stock split companies. But before we proceed, here's a quick question. Have you ever wondered why companies decide to split their stocks? Let us know your thoughts in the comments below. Next, let's look at Chipotle, ticker CMG, a name synonymous with delicious burritos and robust growth. Chipotle's stock is currently trading at $61 post-split. Unlike Nvidia and Broadcom, Chipotle's growth strategy focuses on organic expansion. The company continues to open hundreds of new locations each year, boosting its revenue without relying on major acquisitions. Existing locations are also seeing increased revenue, thanks to innovative menu items and a strong brand presence. Despite being a restaurant chain, Chipotle has shown solid financial performance, with revenue reaching $10.2 billion. While this is significantly lower than Nvidia and Broadcom, Chipotle's steady growth and expansion strategy ensure it remains a strong contender in the market. The company's profit margins are also on the rise, supported by strategic price increases and a successful takeout business that thrived during the pandemic. As Chipotle continues to expand, its financial metrics are expected to improve, making it a noteworthy stock for investors seeking growth in the food industry. Lastly, Broadcom, ticker AVGO, a heavyweight in the semiconductor and infrastructure software industry. Broadcom has not yet adjusted its trading to reflect its upcoming 10-for-1 stock split. Currently, its shares trade at $1,729, but this valuation will be significantly lower post-split. Broadcom's revenue stands at $42.62 billion, and it's poised for further growth as it integrates its acquisition of VMware. This acquisition is expected to boost Broadcom's revenue significantly over the next few quarters, making it a formidable competitor in the tech space. When comparing profitability, Nvidia once again takes the lead with an impressive operating profit margin of 59.84%. Broadcom follows with a margin of 33.5%, and Chipotle comes in at 16.71%. It's worth noting that Broadcom's profitability may initially dip as it digests the VMware acquisition. However, cost-cutting measures and synergies from the merger are expected to restore and potentially enhance its profit margins in the long term. Chipotle's profitability is on an upward trajectory, thanks to increased efficiency and strategic price adjustments. The company's operating profit margin is expected to climb towards 20% as it continues to expand and attract more customers. Nvidia's margin might face slight pressure as competitors like AMD and Intel launch their own AI chips. However, Nvidia's innovative capabilities and market leadership are likely to sustain its strong profitability. Cash flow from operations is another crucial metric where Nvidia excels, with a cash flow to sales ratio of 50.8%. Broadcom follows closely at 44.45%, and Chipotle lags behind due to its capital-intensive growth strategy. Unlike tech companies that can scale operations with relatively lower capital expenditures, Chipotle's business model requires significant investment to open new locations. While this impacts its cash flow from operations, It also underscores the company's commitment to growth and expansion. Valuation is a critical factor for investors, and here's where Chipotle surprises us. Despite being a restaurant chain, Chipotle's stock is more expensive than Nvidia and Broadcom when measured by the forward price-to-earnings (PE) ratio. Chipotle trades at a forward PE of 45.8, making it the most expensive of the three. Nvidia's forward PE stands at 35.6, and Broadcom's at 28.62. This high valuation reflects investor confidence in Chipotle's growth prospects, but also indicates that the stock may be overvalued compared to its tech counterparts. Given these metrics, if we had to choose one stock among Nvidia, Chipotle, and Broadcom, Nvidia would be my top pick. Despite its higher valuation, Nvidia's leadership in the AI and GPU markets, coupled with its strong revenue growth and profitability, makes it a standout choice. Broadcom also presents a compelling case, especially as it integrates VMware and enhances its revenue streams. However, Nvidia's innovative edge and market dominance give it a slight advantage. Chipotle, while a solid company with impressive growth, faces challenges due to its high valuation and capital-intensive business model. Investors looking for exposure to the tech sector would likely find Nvidia or Broadcom more attractive, given their robust financial performance and growth potential. Let's take a closer look at the table summarizing the key metrics of these companies post-split. Nvidia, with its share price at $128, leads the pack with an impressive revenue of $79.7 billion and a robust operating profit margin of 59.84%. This is complemented by a strong cash flow to sales ratio of 50.8% and a forward PE ratio of 35.6, reflecting its dominance and innovative edge in the AI sector. Chipotle, trading at $61 per share, has demonstrated significant growth with a revenue of $10.2 billion and an operating profit margin of 16.71%. Despite the capital-intensive nature of its business model, its forward PE ratio of 45.8 indicates strong investor confidence in its expansion strategy and market presence. Broadcom, currently trading at a pre-split price of $1,729, shows strong potential with a revenue of $42.62 billion and an operating profit margin of 33.5%. Its cash flow to sales ratio stands at 44.45%, and a forward PE ratio of 28.62 highlights its attractiveness as it integrates its acquisition of VMware. Each of these companies brings unique strengths to the table, making them compelling choices for different types of investors. Nvidia's tech innovation, Chipotle's market expansion, and Broadcom's strategic growth through acquisitions provide diverse opportunities in the investment landscape. Before we wrap up, let's consider the broader implications of stock splits. While stock splits don't change the fundamental value of a company, they can make shares more affordable and accessible to a wider range of investors. This increased accessibility can boost demand for the stock, potentially driving up its price. For companies like Nvidia, Chipotle, and Broadcom, stock splits can also signal confidence in future growth, further attracting investor interest. As promised, here's your bonus tip. To maximize your gains from stock splits, consider the company's long-term growth potential and financial health. Stock splits can create short-term excitement, but the real value lies in the company's ability to sustain growth and profitability over time. Look for companies with strong fundamentals, innovative capabilities, and a clear path to future growth. By focusing on these factors, you can make more informed investment decisions and potentially achieve greater returns. Another aspect to consider is the psychological effect of stock splits. Many investors perceive lower-priced shares as more accessible, leading to increased trading volumes and potentially higher stock prices. This effect can create a positive feedback loop, where rising prices attract more investors, further boosting the stock's value. However, it's crucial to remain focused on the company's fundamentals and long-term prospects rather than getting caught up in short-term market movements. In conclusion, stock splits are exciting events that can create opportunities for investors. Among Nvidia, Chipotle, and Broadcom, Nvidia stands out as the best stock split stock to buy, thanks to its strong financial performance, innovative edge, and market leadership. Broadcom also offers significant potential, particularly as it leverages its VMware acquisition. Chipotle, while a great company, may be less attractive due to its high valuation and capital-intensive growth strategy. Thank you for tuning in to Simple Investing Secrets. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insightful content. Here's a final question for you. Do you think stock splits make a company a better investment, or is it just market hype? Share your thoughts in the comments below. And remember, this video is for informational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. See you in the next video.